Michael Burry, the investor made famous by The Big Short, has made a huge bet against the stock market once again. This time, he has taken massive short positions against the Nasdaq and S&P 500 indexes, betting that a market crash is imminent. Burry has purchased over $500 million in put options on these indexes, a move that could net him over $1.5 billion if stocks plunge as he predicts. He isn't the only big name betting on a downturn. Warren Buffett recently sold $8 billion in stocks, stockpiling a huge cash position to weather the coming storm. With the S&P 500 and Nasdaq at all-time highs, what exactly do these investing legends see on the horizon that regular investors don't? Burry's big short position. While Burry has put over 90% of his fund's capital into this trade, the potential $1.6 billion payout is the maximum possible value if stocks crash completely. Still, it's a massive short position. Burry made his name accurately predicting the 2008 housing collapse, making himself and his investors over $800 million shorting mortgage bonds. Though he has made and retracted various doomsday predictions over the years, his actual trades show he still has a knack for spotting bubbles. Investors mirroring his moves would have returned 56% over the past 3 years, compared to just 12% for the S&P 500. Why Burry is shorting index funds? This time, Burry is shorting index funds tracking the overall market, like the Nasdaq 100 and S&P 500. These exchange-traded funds, ETFs, allow investors to spread risk across hundreds of stocks while easily trading like single securities. Their popularity has exploded, with assets growing 15% annually since 2010. However, Burry sees fatal flaws and instability being masked by the broad diversification of index funds. The Nasdaq 100 tracks the 100 largest non-financial companies on the Nasdaq exchange, but is heavily weighted towards big tech. Just 6 firms, Apple, Microsoft, Amazon, Alphabet, Tesla, and Nvidia, make up over 50% of the fund's value. The S&P 500 is more diversified but still skewed towards tech. Nvidia stock specifically has skyrocketed 200% this year based on optimism about AI and technology dominating the future. Burry sees these valuations as a bubble, with Nvidia and other tech firms wildly overvalued if projections don't pan out. Additionally, as rates rise, money loses value and expensive loans become prohibitive. This threatens profitable tech companies relying heavily on venture capital and cheap debt, setting up a dot-com-style bubble pop. Impending market triggers. Beyond overextended tech valuations, Burry sees several triggers that could tank stocks and indexes. China's faltering economy. Expiration of student loan pauses equals less spending. Banks limiting lending. High inflation eroding consumer purchasing power. Millions priced out of the housing market. Corporate investors like BlackRock have bought over 30% of homes in some markets, leaving regular home buyers unable to compete and forcing millions into perpetual renting. This dangerous trend pulls money out of communities and funnels it back to Wall Street. Combined with stagnating wages and soaring home prices far above incomes, millions can no longer afford housing. These worsening conditions for the working class will reduce spending and economic growth. Meanwhile, AI and automation threaten to displace millions of jobs before solutions can be implemented. The result will likely be a painful, prolonged recession. Michael Burry's track record. Burry has been wrong before, so his predictions shouldn't be followed blindly. However, his actual market trades have proven very successful in recent years. While no one can predict exactly when crashes happen, the inverted yield curve, housing bubble, high corporate debt levels, and other fundamentals do point to an overheated market. Other respected investors like Warren Buffett see the excess as well. When experienced pros like Burry make moves this big, it's wise to consider the possibility of a coming correction. In the end, Michael Burry's huge short position represents a warning sign for investors. While timing the market precisely is impossible, the conditions he sees, high inflation, geopolitical instability, overvalued assets, and unfavorable conditions for working Americans point towards an impending recession. Caution and protective assets like cash may be warranted for those nearing retirement. However, long-term investors may be best served sticking to their plan, focusing on fundamentals over predictions. While we don't know exactly when the next crisis will occur, diversification and avoiding reactionary moves based on fear is likely the best path forward for most. That's all for this video. I hope you enjoyed it. Thank you so much for watching. If you like this video, please give it a thumbs up and subscribe to my channel. Your support really means a lot to me and helps me keep making videos. Don't forget to click the notification bell so you get notified whenever I post new videos. I read and appreciate every comment, so let me know your thoughts down below. I love hearing from you guys. Thanks again for watching. I'll see you in the next video. Bye for now.